And in fact, I have to tell you, I arrived in Europe in 1960 with my new wife. Still have the same wife. Situation has changed a lot. And I am a partisan of what I would describe as the Kohl, Mitterrand, Thatcher point of view about Europe. Europe has to do something in order to keep itself together to avoid a third European war, or fourth, if you wish. I think the tensions are latent. I think they're always underneath the surface. I think Thatcher, Kohl, and Mitterrand's decision to come up with a single currency was absolutely essential. It has proved to be the glue, and this is why when Americans in particular thought that the euro crisis beginning in November of 2009 was the end of the euro, I saw a strategic political threat to Europe, and I'm glad that Draghi had the courage and the good sense to say he'll do whatever it takes to save the euro. So that's where I'm coming from. I remain a partisan of the euro, of the European Union process, and it is essential. Now, markets screwed up badly for a long period of time. We began trading the euro for financial transactions in January of 1999. We forgot within 2 months what the individual currency bilateral rates were, and thinking in terms of the euro is very easy. The markets seem to accept convergence. You may recall convergence. And the yield spreads over the Bund were absolutely remarkably benign. As recently as late 2005, the Spanish and Italian yields were at 3%, slightly above 3%. Then, of course, the markets ran into a wake-up call in 2007 when my bank here in Paris, the BNP Paribas, said it would refuse to redeem the SICAV, the mutual funds that had invested in subprime paper sold to them by three of the most distinguished in American investment banks, and who, beginning in January, February of 2007, with the real estate crisis beginning in the States in December, or peaking in December of 2006, had a wider and wider spread on the bid-ask for subprime paper, and then by June and early July of 2007, refused to give any price whatsoever. The first week of August 2007, the BNP refused to buy those shares back, and the markets turned around and saw the emperor had no close, and within 3 days, the LIBOR market had frozen, and a number of other markets had joined it. I would point out that it was the ECB which poured hundreds of billions of euros into the European system in order to maintain liquidity, and then arranged swaps with the Federal Reserve. So the ECB was well in advance of the Fed in recognizing the liquidity problems caused by the subprime mortgage in the summer of 2007. Since then, the markets have persistently kept pressure on the Europeans, and especially when they discovered that sovereigns were not really guaranteed by realistic convergence of their fiscal balances. In particular, Greece, Italy, Spain, Ireland, Portugal had big problems. So as a result of that, in my first slide, I say, thanks, Greece, for saving the euro. And you have slides here which are printed. So, and I'm going to be referring to these regularly. The changes since the Greek crisis began in November of 2009 are substantial. Working backwards, there is the Draghi guarantee, who said he would do whatever it takes to save the euro. They got around to understanding that banking union was absolutely essential to saving the euro system and the euro currency with the ECB as a single regulator. The European system of financial supervisors was created 2 years ago. The European stability mechanism to bail out states requiring a bailout was created almost 3 years ago now. Fiscal pact for fiscal coordination and vetting national budgets also has become part of the picture. It is not functioning, but it is being talked about. European Council on Systemic Risk is functioning and working with the Feds or the U.S. Board on Systemic Risk as well. The unlimited 3-year financing for Eurozone banks to ensure liquidity and avoid another liquidity crisis in 2 tranches, total over 1 trillion euros. Cyprus and Greece, I regard both of those as very useful further market pressure on the European politicians who have been forced to make these decisions that they never would have taken if it hadn't been for the market pressure. EU-wide deposit insurance exists, but it was put into question by the bail-in of depositors in the Cyprus crisis. As a result of that, they now are moving toward a Eurozone-wide FDIC type of program. Now, one thing that I find most Americans are not aware of is that on the second page of slides, the European System of Financial Supervisors includes 3 different types of supervisors: the European Banking Authority, the EBA, and I urge you to take a look at their website. They are doing some remarkable reporting, particularly after their first round of asset quality review and stress test in 2011, which were widely ridiculed, even though they discovered that 26 out of the 90 banks examined were failing their capital ratios, both in terms of percentage and in terms of quality. So they are now, together with the ECB, doing an asset quality review, as Axel Weber said yesterday, and then they will be doing the stress test starting this summer and autumn, and that's expected to be far more stressful for the European banks for reasons I'll come back to. The European Systemic Risk Board is, I understand, working closely with the Financial Stability Board, and it's chaired by the ECB, rather, as the Fed is chairing our Systemic Risk Board. There is a separate authority, European Securities and Markets Authority, which is having some significant effect on the sale and regulation of securities of all types. And then there's a separate one for European insurance and occupational pensions. And I would point out that in the U.S., for instance, we still have no federal oversight of insurance. It's done state by state. And this is, in my view, a major problem. Parenthetically, I might point out, some of you may be aware that the New York State insurance regulator came out with a report last September, I think it was, in which he noted that the life insurance companies are now resorting to captive reinsurance companies headquartered in Georgia and Vermont, and that they are, with this captive reinsurance company, no longer outsourcing the risk associated with my life insurance, for instance, with Metropolitan, to third parties, and therefore they don't have to have as much expensive capital tied up in doing that. The total amount of outstanding life insurance policies, just life insurance, of those top 10 life insurance companies reporting to the New York State regulator, total $4.7 trillion at the time of this report, roughly double the subprime paper that was outstanding in 2007. So the fact that the U.S. does not have a federal insurance regulator, I think, means that the Europeans are ahead in this particular area. That's right. Yeah, that's another aspect of it, and that's a completely separate and incremental amount. That's right.
On a slight addition, I happen to be, among other things, a referee for the Commonwealth.
This is a Yaley speaking. Oh, you're Pennsylvania. That's right. Okay.
I'm sorry. But I'm as I said, a referee for the Commonwealth Court of Pennsylvania on insurance documentation. And it is a Byzantine system, there's no doubt about it, and because of an absence of nationwide standards. But there is a uniform act, as we say in the legal business, which has been some degree of uniformity, but I agree.
Right, but there is no sort of single federal regulator, and there is...
Each state has its own insurance commissioner and...
Right, and regulatory arbitrage, and in fact, the New York State Insurers Commissioners report triggered a reaction among a number of states who are now following this up, specifically about the captive reinsurance companies.
They set up that way deliberately. You know that. Yes. In the 1930s,
Yes, yeah, of course. You know, they succeeded in avoiding regulation. No, that's right. And in large part because of the employment that they represented. Any case, that's an aside, close parenthesis. 2 weeks ago, exactly 2 weeks ago today, Jean-Claude Trichet, who I think is underestimated by the markets because he was head of the ECB at a very, very difficult time. He made an interesting presentation to the NABE Policy Conference in Washington about the conceptual convergence of central banks. And listening to Charles and Christian speak yesterday together with Axel Weber, I think the points that he made, Trichet, in Washington 2 weeks ago, about the conceptual convergence between the Fed, ECB, Bank of England, Bank of Japan, is interesting, and that is that price stability is their target primarily, and that they seem to be converging on 2%. This is a key target, and particularly as we are in a disinflationary spiral that risk turning into deflation, that is interesting. Communication is essential. Surveillance of banks, these are the shared characteristics of conceptual convergence. Surveillance of banks and non-bank financial risk must be shared by the CBs, but not necessarily exclusively. In other words, you must have separate regulators in addition to the central banks. Monetary and credit creation by banks and non-banks is essentially the responsibility of central banks. Unconventional monetary policy, whether it is of the ECB sort or the QE sort of the Fed, must assure, under any circumstances, system liquidity. And I think this is the interesting point that the ECB made in August of 2007. And then forward guidance to markets is necessary but must not damage central bank's credibility. I got irritated at a series of articles that appeared in the Financial Times a couple of months ago and wrote a letter to the Financial Times saying that this is excessively soft on investors. And in fact, investors who get paid very well should have to work more for their money and be forced to make guesses about which direction monetary policy is going in instead of having it guaranteed that short-term interest rates will remain near zero for the next 2 years. And so the FT published my letter together with a photograph of a baby sucking on a pacifier. And the pacifier had a picture on it, and that was of a pig snout. So I thought it was a very appropriate use of my letter and point. The EBA on this next chart, called EBA Risk Assessment of European Banking System, is quite interesting. This is from their December 2013 report. And it struck me that this shows how the markets believe in the Draghi guarantee. Do you have it on that chart? Is it written? This is the chart here on EBA risk assessment. What it shows is the divergence between the Euro Stoxx share index, the Euro Stoxx 600 bank index, and the CDSs on European banks. So that widening gap there since the crisis peaked back in 2011 and 12 shows that the markets really do believe in the Draghi guarantee. However, there is a problem with the Draghi guarantee and the LTRO injection of over €1 trillion euros of liquidity, and that is that the banks are deleveraging and they use the cheap liquidity to buy sovereigns. And this is where the European banking system is finding itself particularly vulnerable, especially as the definition of sovereign credit risk weighting has not been decided yet by the EBA or the ECB. For instance, some examples. As of This is as of December 13th. Spanish banks have increased their holdings of sovereigns from 5% to 9.4%. Italy from 6.4 to 10.3%. Germany even has gone from 3.8 to 4.5, and France has added 1% to its holding of sovereign debt. One of the characteristics, however, is that these banks are holding more and more national debt. German banks are not holding Greek or Cyprus or Irish or Spanish or Italian debt. So this is what has led the EBA to talk about the fragmentation of the euro banking system. In other words, it's returning to national banks holding national sovereign debt. And that sovereign debt could be a problem when markets wake up to the political risk that politicians represent still. On the next chart, top 20 EU banks' core Tier 1 ratios improve. In fact, the EBA points out that the Eurozone banks have done more to add to their CT1 ratios than have the U.S. since 2005 in absolute quantity terms. However, there is a qualitative difference in that the June 2013 ratio for the U.S. banks and for the EU banks is just about the same. However, the U.S. banks have raised their CT1 ratios by issuing more equity. They've had more retained earnings. They've had much bigger share buybacks, and they've been much more profitable since 2010. So that there is a qualitative difference between the European and U.S. core Tier 1 ratios. And that I think is important. Fiscal tightening, these came out of Martin Wolf's piece in June of last year, the belt tightening that's gone on. Fiscal tightening continues to be a major aspect of the European recovery process, and the amount of fiscal tightening is quite substantial.
I rearranged your slides. They have them in different order.
Oh, they do? Okay.
So you might want to just hold up which one.
Right. Sorry. Yes, this is the FT chart, the Euro peripherals debt and belt tightening. The core Tier 1 ratio chart is the blue bar chart here. You may have found that. Let me move on and conclude because I'm using up far too much time here. In addition to the yield spreads declining quite substantially, I would point out that the exchange rate of the euro has been another indicator of the market's confidence in the Eurozone's forced rehabilitation and improved governance, if you will. The average rate since the crisis began, the euro crisis began in November 2009, has been nearly $1.31. And this despite all of the forecast of the Eurosceptics forecasting that the euro is going to go out of business. It continues to be very stable. This morning it was quoted at 138.66. In fact, on a trade-weighted basis, the euro is up on about 6%. On a real trade-weighted basis, up about 6% since November 2009. So the exchange rate is doing very well. The spreads over the bunds have converged very substantially and I think are relatively realistic at this point. So the two markets, fixed income markets and the foreign exchange markets, are telling us that the worst of the euro crisis is behind us. Then we get down to some economics. This is the euro area forecast. The table here, which I've summarized, this is the European Commission's February forecast. Let me just give you some by way of reference, showing that the Commission, in my view, is too optimistic. The private sector consensus forecast for the EU GDP growth this year is 1%, 1.4% in 2015. Germany is more or less on target with the private consensus. France is expected to be less than 1% instead of the 1% forecast by the Commission. And the unemployment rate, the forecasts are roughly the same. So some improvement this year and more in 2015. Let me finish by a news item which came across late yesterday, and that is that the European Parliament is discussing a single authority to resolve TBTF banks in the Eurozone. There are two projects here. One was approved by the European finance ministers last December, and they, under the finance minister's approval, the governments would build up national bank resolution funds by imposing levies on the banks, and then they would sign a separate treaty to allow these funds to be gradually merged into one European pot containing over 50 billion euros over the next 10-year period. The European Parliament, however, has a different one. They would like to have the final mechanism in place within 3 years and not have a treaty. So that there is a fundamental difference here on the resolution mechanism that is essential to the banking union, which is going to allow the Euro banks to function more efficiently when there are crises. I was very interested by Axel Weber's response to my question yesterday about the details of the resolution agreement, the 1,000-page document that he talked about, and he was very specific about the being entirely bail-in, and the bail-in being related to the legal and corporate structure of the banks. As he pointed out, ultimately it should come back to the umbrella holding company, which decides whether to add equity, to sell assets, or to force operating entities to reduce their activities. And I think that's what the European Parliament is aiming at, but very quickly. They also want to avoid having a new treaty, because as soon as you introduce a new treaty in the euro area, you introduce political resistance in individual countries, which make it almost impossible to do. So if you can get an agreement, and here we're speaking primarily of the Germans' willingness to participate in any kind of a resolution authority for Italian or Spanish banks, then you have a workable solution. If you have to have a new treaty approved in order to have a resolution authority, you're not going to get a new treaty, you won't have a resolution authority, and you will not have banking union, and therefore the markets will come back and test the Draghi guarantee. So anyway, there are a few very general points for you who are interested in banks.
Well, that was terrific. Thank you. So Jill reminded me, I forgot, of one very important item. She's going to come around and give you a place setting that has what you ordered for lunch. If you lose that, you don't get to eat. So you want to hang on to it, because that's what the waiter will know. And the other thing is, we are going to try and stay on schedule to really have a 12:30, 12:35 stop to eat, so those that are going to the archives can get there. So what we're going to do now is we're going to jump across the Atlantic to the U.S. And Don's going to walk us through kind of how the U.S. looks. And I just want to mention one thing as it comes up about how financial repression works. If you go back 2 years, you remember the whole story of the death spiral. The banks were buying the sovereigns couldn't buy the banks. So I just, as an anecdotal thing, I'd mention, just ask yourself what yields the sovereign debt was being bought by the banks. What were yields? 7, 7.25, 6.50, 6.25, 6, 5, 5.50. So the amount of money the banks have made on the back of, I will do everything to save the euro, is just stupendous. Somebody has to pay for that. We'll talk about that later. But just from a frame of reference of the healthiness of the banking system in Europe, because of what Paul said about Draghi's statement, the impact is all of those bonds they bought when everybody thought the world was going to end are now worth a lot more. And they can hold them as capital, or they can sell them. And so with that.
Well, thank you, Steve. So I have the task of talking a bit about some of the U.S. data, and the story generally is one of recovery. I don't think it's all that different fundamentally from what we're seeing in Europe or Japan, different than some of the emerging markets, but let's start with a thought experiment, which is, so there'll be a couple, but I'll probably just reference them to the end on the slides. So The thought experiment I'd start with is if you had a factory with 10 workers making 10 widgets and you had a shock, whatever that shock is, from China, let's say, and your demand falls from 10 to 7, well, you wouldn't cut your workforce from 10 to 7. You'd be forced to cut from 10 to 4 because you built 3 widgets in inventory you have to get rid of. And the point I'd make is recovery is quite easy to get because you're going to have to rehire. You're going to have to get that replacement spending. You're going to have to get some reversion to the mean, even if you never get back to your prior level of sales. And so if we think about a business cycle, I'd say it's critical to think about the downturn or recession sometimes, then the recovery, getting back to your prior peak levels of production, then expansion, which is different than recovery. I think breaking expansion and recovery into different parts is very important. And it's very important today because I think there are a lot of economies around the world that look like they're showing signs of recovery. Whether they make it to an expansion and how long that expansion can go, I think is a different question. So in the U.S., we're basically telling a story of pent-up demand. We think GDP in the second quarter will accelerate towards a 3.5% growth rate on a quarter-to-quarter annualized basis. The sectors we're looking at as drivers of growth over the next year are places where we've seen some pent-up demand. We'd look at capital spending, we'd look at housing, we'd look at state and local government spending. State and local spending I'd put as a distant third on that list. It probably won't be a very large driver of growth, but it's nice to have it slightly positive rather than slightly negative. If we think about the core private sector demand drivers, we'd look at capital spending and we'd look at housing. On capital spending, we've had some very odd behavior in some of the census data on shipments and orders that we typically use to proxy for capital spending. If you look at core capital spending numbers, we typically look at non-defense orders and shipments. Sometimes you take aircraft out to try and smooth it. If you start looking at those data, they've been flat for quite some time. They're just starting to turn back up. Well, the economy hasn't been flat. It may not have been growing as much as we would like, but it's been growing. And so to have relatively flat capital spending in a growing economy is strange. Capital spending is typically a cyclical variable, goes up in expansions, down in recessions, and it's flattened out. So first of all, this is the opposite of any structural story we might tell. So we get a lot of questions about the manufacturing renaissance or the energy revolution or smart manufacturing, material science. That would suggest maybe we'll have stronger capital spending, maybe weaker employment. What we've seen is employment's been okay. We'd always like it to be better, but it's been growing. 175,000 a month with some special factors is okay. Capital spending's been flat. So to have growing employment, flat capital spending, that divergence is quite odd. So if we look at the employment of labor and the employment of capital, they typically swing together. You can get correlations up around 80% plus when you use various series to look at jobs versus capital spending. So they've broken apart for quite some time now, over a year. And so the simple point we'd say is that has to narrow. Now, that could narrow either by employment falling a lot or capital spending picking up a lot. None of the data we see argues that the labor market's weakening substantially. So if we look at payroll employment, that's growing. If we look at jobless claims, they're low. If we look at layoff announcements, they've come down. If we look at the number of people quitting their job, that's started to rise. So the labor market generally looks like it's continuing to improve. It may not be improving quite as fast as we would like, but it's improving. That would say it's going to be very hard to keep capital spending flat. One or the other has to give. So we'd look at that and say that looks like some pent-up demand for capital spending, at least replacement spending. Whether or not we'll get greenfield addition to plant, I think, is a different question than if you employ 200,000 more workers a month, they're going to break things. And so that's the first step. That's where the bounce comes from. That's why it's so easy to get a recovery in many cases. Second sector I'd highlight is housing, and we can talk about construction. I think there's some interesting data there. But household formation was mentioned earlier, and that's looked remarkably weak. And if you look at census data on the number of households, you can define a household as an occupied housing unit. So it doesn't matter whether you buy or rent in some of these series. Even if you take the all-inclusive measure, it's still been weak. So not only are we not buying homes, we're not renting apartments.
And if you look at them by age quintile, literally you find that it's down until you hit 55 years old, with no real sign of improvement. And we've you've got record high levels of 18 to 34-year-olds living at home with their parents.
So the comment is how the age distribution would also say it's 55 and older, where you're getting some formation and record numbers of.
So historically, between 25 and 34, we were at almost 26%, 27% of all 25 to 34-year-olds living at home with their parents. Historically, it would have been about half of that.
So you've been running half speed on household formation in a number of different series. So the question I would ask is that permanent or temporary?
And it's job-driven. It's down payment-driven.
Yeah. Well, I would say it's more job-driven.
Absolutely student debt.
It could be student debt-driven, I think, for buying a home. In other words, I think there is clear structural change in how you buy homes. Down payment requirements are different. Lending standards are different. The amount of student debt that's been accumulated is different. Renting an apartment may be a middle ground. In other words, it seems to me that could be more related to whether you have a job.
Question on that. So you're saying that the variable to watch is household formation?
I think the first variable to watch is household formation. I think that.
Your business, that's what they track all the time.
And because it's been so weak, and if in construction it's important as well, if it's been so weak, we have to decide whether it's gone for good or whether it's pent-up demand. That would be the way I'd think about it. And a question on.
I would suspect that number is probably true for Europe as well. Same amount.
And the same could be true in Europe, that you have the household formation
Because
issue.
you have an unemployment rate for the youth in Greece and Spain and so on of over 50%. There is no household formation in that bracket.
And we're saying with over 50% unemployment rates for youth.
Yeah, but that's
For youth. Right.
How can you have, household formation, or how can you have new homes being built? But, I would just suspect the numbers are probably the same.
Right. So let's say that's even more global. Again, I'd say, is this something that's permanent or is it temporary? I think if it's tied to unemployment, we have to conclude it looks more like pent-up demand than structural change. If it's tied to unemployment.
In terms of the purchase market, I think you have to.
I agree with purchase. I'm saying if you take the broadly purchase plus rent defined. And I'd say when we looked internationally, we can't find a good correlation between home ownership and economic growth. It seems to be more important that you house yourself. How you do that seems less important. We can find some countries with high home ownership rates and the economy does poorly. We can find some countries with more renters and it's okay. So it seems to be more important that you house yourself. How you finance that seems less important. So that's why I'd say take the census data on occupied housing units. Let's abstract from whether you can buy it right away, because I agree there's a lot of differences on that side. So if we look at where household formation broke, it broke around the financial crisis and the recession. It was when unemployment went very high. So in the U.S., unemployment got to 10%. And the post-war peak in the unemployment rate was 10.8% in November and December of 1982. So the highest number most folks remember is about 10. So 10 is a scary number. It would change behavior. It has that characteristic. The last time you went above 10.8, you went to 25, which was the Depression. So it is legitimately scary that you could approach a nonlinearity. Now unemployment's coming down, and the point I'd make is unemployment very rarely goes flat. So if you look at the behavior of the unemployment rate, it's a very autocorrelated series. It doesn't jump around. You don't go from 10 to 5 to 10. It's very smooth. Very rarely goes sideways. So think about what it would mean for the unemployment rate to stay the same number year after year. It would imply very different labor market characteristics than what we observe. People generally sort themselves into the jobs that are available. Some jobs become obsolete. Some jobs are new. Universities didn't know many decades ago they need software programming divisions. Now it's one of the most popular majors. So I'd say the dynamics of the labor market itself would suggest that the unemployment rate very rarely goes flat and only goes up in recession. Most of the time, if you look at expansions, the unemployment rate's coming down. It's not that hard a forecast to say as long as we don't have a recession, the unemployment rate's going to be lower several years from now than where it is now. So that's where I'd say it looks like there's some pent-up demand for household formation. If we can get the unemployment rate down to more normal levels, I mean with a 6 handle or a 5 handle, which is where we're starting to get now, you should be able to get the kids off the couch. Right? And we'd say you could have up to 2 million kids on the couch if you take trend growth rates. You have a little over 100 million households, as we were saying before. It's that it kept growing more in line with population growth instead of half speed. You could find numbers up to about 2 million in pent-up demand.
So, two questions. One is, even if the unemployment rate comes
So the question was on whether we're creating jobs that are of such poor quality that we may not get the kick that we normally would. If we look at multiple job holders as a share of total, that hasn't gone up that much recently. So there's been some concern, for instance, that with the new healthcare legislation in the U.S., that we've advantaged hiring part-time workers versus full-time workers. That may be an issue, but we don't see it in the data yet. It may be coming. So I'm not saying that it will never happen. What I'm saying is I don't think it's an explanation for what's happened in the past. It seems more like a concern for the future. And if these divergences, especially CapEx versus employment or household formation versus average, if those are things in the past, they can't be explained by multiple job holders, part-time work relative to trend. So part-time work comes first, but part-time work usually can lead to better things as well. In other words, we're just replacing one divergence with another divergence there. If we're saying there's not enough full-time work versus part-time work, well, those are supposed to move together as well. So, and then the question on wages, there's been restrained wage growth in aggregate, but if we take the industry data, it's sometimes hard to say that a low-wage industry results in only low-wage jobs. So if we say there's a lot of retail hiring or leisure hiring, those aren't necessarily low-wage jobs. They can be. But let's agree. I think that there are concerns about the quality of jobs that are being created. I worry that's more fundamental than not. In other words, what we've seen is we've made certain sectors of the economy very productive. And the problem with that is they just don't employ that many people anymore. So agriculture has become extremely productive. It used to be 40% of the U.S. economy. It's fallen to less than 1%. Yet everybody, for the most part, is able to have some access to food. In other words, you're still fulfilling the purpose of that sector with just a very small number of people. Manufacturing has seen similar productivity gains. You're making an awful lot of things. So the entire goods production sector has gotten more efficient. And it could get even more efficient. In other words, the stories we're telling about productivity growth, the stories we're telling about manufacturing recovery would tell us that that goods production sector is going to get even more efficient. So where are people going to work? They're going to work in the service sector. Now, the problem I would say with the service sector is it's not obvious what a middle-of-the-line service sector job is. There's high productivity service sector jobs. There could be low-wage service jobs. It's not immediately obvious what kind of the middle-of-the-road service sector job is, and we are creating new jobs. It's just not clear that they're the type of jobs that are going to support standard of living. So I had to walk between two clients. This was last year in California, and we had to go through a shopping mall to get from one to the other. This was in Newport Beach, California. And in the mall, there was a hair salon, and the salon had a sign that said, "We don't cut hair." And it said, "We don't color hair. We only blow dry hair. $35. So as best I can tell, that's a brand new service job. Because if you did that at a hair salon, you would have crowded somebody else out who actually wanted a haircut. But now you can do both. Now you can get your hair cut and blow dried. Yeah, and so at first I thought this was some odd California thing. But I've since discovered that it's all over the place. It's very popular. So as best I can tell, that's a brand new job. And now the problem with that is the person doing the process, the blowout, may not be making $35 a half hour. The person owning the salon may make a good amount of money there. But that's the tension I think we see, is the service sector is different. The service sector is where we're likely to add jobs, and we'll keep making new jobs. It's not that hard to create jobs in the service sector if we think broadly. And so to move on and just give you a few more points before my time ends, let me go back to this story of pent-up demand and say, if we get the unemployment rate down and if we can get better wage numbers, we're starting to see that, we think that can continue, then if you have a bounce in capital spending, a bounce in state and local government spending, a bounce in household formation, if not the first-time buyers of single-family units in the same degree, that's where the lift comes from. But what's the longer-term trend? We think that's going to be driven by what always drives trend economic growth, which is population growth and productivity. And the bigger question is on productivity. So we talked a lot about banks. I think part of central bank policy is always to hold the banking system together in times of stress because you don't want the unemployment consequences of the big failure. So in the U.S., it's hold the banking system together, hope we can frack our way out of this. That's roughly the plan. Or it's hope for that next productivity gain. It's buy time. Pull activity from the future, buy enough time to let the private sector try to get productivity up. Now, I think it's early to declare victory on that. In other words, the sources of productivity that we might talk about, whether we're talking about an energy policy, whether we're talking about cars that drive themselves, whether we're talking about technology out of Silicon Valley, they're developing. But when we look at places we might suspect that would show up, when we look at the productivity data, when we look at models of productivity, when we look at the trade gap, when we look at the unemployment rate by educational distribution, we don't see that that's there yet. So trend productivity has been quite slow since about 2004. So that predates the financial crisis. This isn't a financial crisis issue by itself. There's some cyclical variables there. But the longer-term growth rate, I'd say, the way that this all works out is if you can get productivity up. And that's still a hope. Or if we think about where we are in the cycle, generally we'd say the periods this looks like could be something mid-cycle. So around 1986, around 1996, around 2006, you had slowdowns that weren't recessions in the U.S. So the old term that was applied to them was mid-cycle slowdown. And that was true. In the 80s, it was a mid-cycle slowdown. You had about 4 years of growth. You got your pause that refreshed. You got about 4 more years of growth to the end of the decade. Same thing in the 1990s, 4 years of growth, pause that refreshed, 4 more years of growth. In 2006, it was 4 years of growth, pause, 1 year of a bounce. So we said the bounce is easy. And then everybody knows what happened next. That was the end of that. So in the first two cases, in 1986, you got 4 years of growth coming out of this mid-cycle period. In the 1990s, you got 4 years of growth coming out of this mid-cycle period. In 2006, you got 1 year. And we think the difference is due to productivity, which is...
There's a cyclical explanation for that because you've got two cycles. You've got your inventory cycle and your business cycle. And these peaks and troughs which you're describing can be explained by that.
I think it's... so the question is on the inventory cycle. And I agree with that. The pre-1982 period was much more volatile, so you have an inventory cycle that sometimes dominated. And so it was hard to have those slowdowns that weren't recessions. 1984 forward or so, you started to see better inventory management, just-in-time inventory, outsourcing of more of the volatile industries, so that helped. What I also think helped is the ability to pay labor and capital at the same time. So in the second half of a business cycle, I think the difference is that you tend to have a rising labor share of income. So if you look at labor share of corporate GDP, the labor share income tends to rise in the second half of business cycle, tends to fall in the first half. And we're probably at that inflection point now. The way to pay labor and capital at the same time is to get productivity up. And that's the challenge now. I think that's why productivity is so important now. So in the 80s, you gave everybody a credit card. In the 90s, you gave everybody a computer. In 2006, you gave everybody a house. 2 of the 3 worked. So it's a question of whether it's more like 1996 or more like 2006 right now. Steve, am I out of time?
A couple more minutes.
Okay.
Any last questions? Yeah, when you talk to the municipal, the state, the ability to increase spending, and it's interesting in all of the discussions that we've had on protectionism, there hasn't really been a focus on the sub-sovereigns and the debt burdens of the sub-sovereigns as a future source of protectionism. So, as you're talking about that is the third but important driver of growth. I'd love to hear where you stand in terms of the ability.
So the question is on in the state level and the sub-sovereign level, where does that fit into the protectionist story?
But where does it fit into the growth story?
And the growth story, right. So generally, when we think about tax receipts at the sub-sovereign level, there are 3 things you could tax. You could tax income, which is what the economy generates this year. You could tax wealth, which is what the economy has accumulated in all prior years. And you could tax transactions as people exchange income and wealth in the economy. And at the national level, the U.S. has tended to use the income tax and other smaller taxes versus other places where you might have a transaction tax, a VAT tax, or a property tax. So the property tax and the transaction tax, the sales tax, tend to reside at the state and local level. So you have a lot of localities that will fund themselves through property taxes. You have a lot of states that might use sales taxes. It's not completely consistent, but roughly I'd say the federal government has more of the income tax, the state and local you're getting more of the property tax revenue, and the sales tax revenue, so the transaction tax and the wealth tax. And if you have home prices recovering, stock prices recovering, and a situation where you're seeing more transactions because the unemployment rate's coming down, you can fund it more out of current income than you otherwise would have. So there's a question whether you should save some of that for a rainy day fund. But I think it's a debt issue where you've had events in the past year. So Detroit, some of the events in Puerto Rico, there have been inflection points. To some extent, they were real stress tests. You've had some stresses in that municipal market, and so far, so good.
One last point. Going back to paying capital and labor at the same time, has the balance of power swung so much to the executive classes that in the absence of a surge in productivity, you're not going to pay labor at all?
So the question is on the balance between capital and labor, has the balance swung towards executives? And if you look at the labor share of GDP, it has been in a downtrend for many decades. Even if you're in a downtrend, you're still following a consistent business cycle pattern, though, which is from a lower low, you're making a lower high, but you're still increasing as you mature in a business cycle, which has happened as well. So that may be correct, that you've had changes at least for a while. I think the implications of how long that can go, we could debate. But even in the last decade, in the last few cycles, you still see an increase in the second half of the business cycle just from a lower low.
So I think Herbert has one last question.
Yes, coming from Europe and also from a country not having a lot of a government debt, I have a question about the U.S. government debt. I'm not talking about the ceiling or the annual deficit, but the total debt. Isn't that any concern anymore? But because nobody talks about it. Thank you.
It's a topic of a conversation.
So the question on debt and why that's fallen off as a headline number, I might say two things. One is the budget deficit has improved quite a bit. One of the biggest factors in determining the deficit tends to be where the unemployment rate is. So if you're getting a cyclical recovery, that matters. You also have changed taxes some, you've changed spending some, so all that has mattered on the deficit. And then the debt to GDP ratio, if you look at CBO figures, looks okay till 2023, roughly. So stable. So
How many percent?
roughly a little over 70. So and so you still have the long run entitlement problem. In other words, none of that's been fixed, but there's no emergency anymore. And so I think that's why it's less of a headline issue.
Just a comment. I don't know whether you're all aware of the discrepancies in comparing these debt ratios. In US, you talk about 70%. In Europe, you talk about, in Greece, something like 120 or 30. But these are different concepts. The IMF concept for US is something like 110%. And that's comparative to those numbers that you read about Europe.
Timo's got a good point there. The debt number, the comparable numbers, but because we now have revenues growing faster than outlays, as long as that holds, it'll start to plummet until about 2023. Don, thanks. Let's have a round of applause for Don. I think that was terrific. As I introduce Livio, one of the things I think Don left us with is if you look at forecasts for the U.S., they're all lower than Don's. So I made a list. If he's right, I want to know it. And so I think he gave us three things. It was, we'll see CapEx come back. We'll see household formations and housing surprise. And then I think this wage number is a big number. I keep track of it. And the bears are like, it's over. Consumers are, under the, we have, capitalists have their foot on their necks and they'll never have enough money to buy another thing. But if Don is right, I know David Rosenberg's been writing about this, the surprise will be wages come back. And so we have three variables we can watch in the second half. We want to thank Don for that. Let me introduce Livio Straka. He's from the European Central Bank. He's come down from Frankfurt. He's the head of international policy analysis. And if you look on your agenda, we have topic 3 is emerging markets and more international. And that's what he's going to talk about. And as investors, it's like one of the cheapest general places on the planet. But it's also one of the parts of the world that has the biggest headwinds and is in the news. And as Livio talks, if you look at this easy-to-read table that I gave you, page 2 in the middle, you'll see emerging markets, MSCIEM. So as Livio's talking, you can see the reference points on earnings estimates, PEs, and valuations. And with that, I'm going to turn it over to Livio. And don't lose your lunch places.
We're eating here, right?
We're going to eat right here.
So, thank you very much, Steve, and thanks for inviting me to this very interesting, the discussion, very interesting format, which is rather new for me. So, as I said, as was said, I will talk a little bit about. Can you hear me, everybody? Yeah. About the slowdown in emerging markets, and I guess the first question we have to ask ourselves is, where is really the new element? So there has been certainly a reassessment in the market participants about prospects for emerging markets, but I would argue that what is happening now in emerging markets was to a very large extent predictable. So it's probably another example of the sort of boom and bust behavior in market expectations that is visible in many other asset classes. So this time we are seeing that in emerging markets. So in DCB we of course follow the emerging markets, and we sort of follow at a more general level all the main emerging markets, but also in much more detail China. So I got to say a few things about emerging markets, and then a few more things about China in particular. So according to our calculations, the slowdown in emerging markets in growth in the last 3 years, and also in the forecast, to a large extent reflects the slowdown in advanced countries. Of course, for them is a source of export demand. So the slowdown in advanced countries' imports is a big part, is a big chunk of the slowdown in emerging markets. And also, when we exclude China, is also the slowdown of China, because a lot of emerging markets, particularly in Asia, are connected through trade with China. So both factors have been waiting for a lot on growth in emerging markets. And I guess the broader question, of course, is about potential growth in these countries. So a lot of the growth of these countries has been, of course, as a process of catching up. And the question is, which form the catching up process takes, right? And in many countries, and China is a prime example of that, the catching up process has been happening through basically manufacturing exports. Right? So countries like India, like Mexico, like China, they have been basically climbing the income ladder basically by exporting manufacturing goods. And there is some evidence, for example, reported in a recent paper by Danny Roderick, recently published in the Quarterly Journal Economics, showing that basically manufacturing acts as a kind of elevator. So why are emerging markets poor? So why they don't have the same income as advanced countries? The main reason is that they have poor institutions. Okay, so they don't have a rule of law, they don't have political institutions as developed as they are in advanced countries and so forth. So there is a reason why they are poor, but the process of developing these institutions takes a lot of time, is slow, and is also affected very much by geographical and cultural factors. So it's not easy to change institution in the short term. So basically what the analysis of Roderick suggests is that you can bypass these institutional weaknesses by concentrating production a lot in manufacturing. So manufacturing allows you to grow and to catch up with the rich countries to some extent. So without having to import the institutions from abroad or to build in a slow and painstaking way new institutions. So the question now is a little bit whether countries having already a large share of manufacturing, whether they can continue to do that also in the future. So if they can continue to use manufacturing in the same way in the future to catch up. And I mean, there is a national limit to how much manufacturing can absorb in an economy. I mean, there are emerging markets where manufacturing is already 30-35% of GDP, and it's hard to believe that the manufacturing can become more than 50% of GDP, of course. So this is going to be there's going to be a limit to which they can use manufacturing, which means that these countries will have to go the harder way, so to build institutions and so forth. So generally, the question is. Yes, whether this, so which kind of form the convergence process will take in the future. And I mean, and incidentally, the paper I was mentioning also shows that while there is evidence of convergence in manufacturing output, there is no convergence. There is no evidence of convergence more broadly in income. So this is not true. It is not true in an unconditional way. It's not true that poor countries necessarily converge to rich countries. So basically, that your income level can predict income growth. Okay, so if you believe in convergence, it means that there is a negative relation between income level and income growth. But actually, so this recent research so finds that this is, at least in an unconditional way, is not the case. It's only the case when income comes from manufacturing. Okay, so that is a kind of a challenge that the main emerging markets have. Of course, commodity exporters have a different kind of challenges. Countries like Russia. So there, the challenges are the usual ones associated with commodity exporters, like the Dutch disease, how to diversify more the economy, and also there, how to improve institutions and to improve also the spreading of commodity wealth more broadly in the population. So those challenges remain and remain largely unchanged. But these countries are not countries which have grown a lot in the last. So the boom in emerging markets which we have seen has mostly to do with countries which have concentrated on exporting manufacturers. Yeah.
Right, Chicago behavior for a second.
Sure.
So one of the topics that's emerged in the last maybe 12 months is emerging markets cyclical, or is there a true trend? You know, there's this belief. I know my colleagues at PIMCO have it, that emerging markets are going to grow faster than the West, and that's the new thing. The alternative is no, they're cyclical. As my friend Michael Jury reminds us, they're hitting the middle income trap, and what we're now seeing in front of us is that we're in this deep cyclical downturn, and the trend will be lower as it comes out.
Yes, that's a good question. So, as I mentioned at the beginning, if you look at the last 3 years, certainly a lot of the slowdown is cyclical, and it reflects the slowdown in advanced countries. So a substantial part is certainly cyclical. In terms of the more sort of potential, I think a slowdown, in particular in China, to which I'm going to turn now, is expected. It was expected. So in my view, there has been there's been a reappraisal in the market, but I mean about factors which were already sort of predictable and visible before. So there is not really a new element in that discussion. So we knew that emerging markets could slow down and the potential growth could slow down.
But where are they going to go next?
There is no way out. So they have to continue to reform, improve the institutions, and painstakingly bring themselves up to the income level of the rich countries. I mean, there is no easy. But I mean, there are countries which are seeing that. I mean, an example is South Korea. South Korea now is as rich as an advanced country, and it's very much. I mean, it's been very much the story of the export-oriented, manufacturing-oriented exports kind of growth model, and they are now. I mean, they're still growing quite fast. Actually, Korea is still growing at I think 3-4%. But there is an internal debate in Korea about what kind of growth model they want for the future. Do they want more innovation and where is the innovation coming from? So is the education system or the political system ripe for fostering innovation? And that's a big question also there. Yeah. Yeah.
May I just add that there's a paper by Barry Eichengreen, and he has been finding out that from 1960 until now, 1960 there were something like 100 developing countries that were reported at that time, and only 13 have made it to a high-income economy.
Mm-hmm.
So
Yeah, no, it's good.
it takes time. It's very, very difficult to get there.
Well,
Yeah.
and that's where I was going to go, is in some sense when we talk about emerging markets, shouldn't we separate the commodity-based versus the
Indeed, yeah.
industry-based economies as opposed to...
Yeah. No, indeed. I mean, as I said before, they are subject to completely different dynamics, and you don't really see strong growth in a commodity. Yeah.
And it's become very difficult for them ever to get the institutional.
Yeah. Yeah. But I mean, I would say that countries which are concentrated in commodity exports are more prone to crony capitalism, to kind of. So it's much easier to be trapped in that. Okay, so let's talk a little bit about China. So as I said, China is a country which we follow more actively. So China has some of the challenges that I have just described, plus additional ones. So one big challenge is the need of rebalancing. So they need to reduce or at least prevent increase of the investment to GDP ratio, which is extremely high. So it's a completely lopsided economy with a lot of focus on investment and very little on consumption. And it is one of the objectives of the, as you know, there's been the plenary meeting, the third plenary meeting of the Communist Party, which is for them is a big event for to set the agenda of economic policy reform, economic reform. And one of the main aspects of this sort of reform plan is to have a market system, have a price system play a bigger role in China, which should be conducive to a better sort of rebalancing or a better balancing of the economy. So not an undue emphasis on investment. And so we have looked at a number of historical experiences. So we have collected all the experience in the last like 50 years where the investment to GDP ratio has fallen to the extent to which it should fall in China. Basically, we have found that these have been almost always episodes of low or negative growth. So the bottom line is that rebalancing, it will likely to be very difficult in China and will sap and reduce growth. And another factor of uncertainty, of course, is TFP growth, so that total factor productivity growth. So nobody knows really. It's been quite robust in China last years, around 3%, I think. But nobody knows whether it will continue in the future. And again, is very much a factor of fostering innovation, but which implies reforming the political system, which implies also having the Communist Party losing its grip on power. So you can see a chain of things which eventually come to political questions. So this is more or less what I wanted to say. Of course, I could elaborate a lot more, but I guess we don't have time to do that. I just wanted to finish with more the financial risks. So there's been one element of debate in the market has been, of course, the effect of sort of tapering, the so-called tapering of the U.S. Federal Reserve. So the fact that they are reducing the purchases of government bonds, and eventually, of course, the Federal Reserve will have to increase interest rates again from the zero level in which they are now. So the question: what will happen to capital flows to emerging markets? So we tend to have a rather benign view of that. So we have not certainly we have seen an increase in capital flows to emerging markets during the after the QE announcements and generally during the period of very low interest rates. But as the IMF has put, there has been no tsunami of capital flows. So you don't see something which is out of whack with compared with the historical experience. So you see something which is they go mildly up, but nothing spectacular. So equally, I would say one shouldn't expect, especially the gradual nature of the readjustment of U.S. monetary policy. One shouldn't expect a tsunami in the other direction. So there has been some element, but not a big.
Would it be possible to give some kind of reference to that
Well, the usual, yeah. So the question is there a reference in terms of quantity? So how much capital flows have gone to emerging markets could? Well, I don't.
Say mid 1990s to now.
Yeah.
How
So I don't. Honestly, I don't have numbers in mind. But what I know is, I've seen the charts, and it just visually they don't come out as being something out of or in a different order of magnitude. I mean, they are within the normal historical variability. And so if you take the Asian crisis, it's actually below what you have seen in the Asian crisis. The usual reference is either the tequila crisis, mid-90s, or the Asian crisis. So we don't. So the bottom line is we don't expect anything like the Asian crisis, even though, of course, and that comes a little bit to the second element I want to mention that, especially more lately, we see a lot of differentiation. So we see a lot of so-called pull factors. So country-specific factors driving the capital flows rather than common factors. So we see a lot of differentiation. Some countries being hit by an outflow of capital by the depreciation. Countries like Turkey, countries like India, and so on. And you see other emerging markets which are not hit at all. I mean, an example is Mexico. So Mexico, I don't think has been hit in any way, but in Mexico, I mean, in theory, should be because it's very close to the U.S. So a lot of differentiation and a lot of country-specific factors playing a role. And finally, I just wanted to mention China again. So there is a discussion about financial fragilities in China. I mean, in China, you have to remember that the credit to GDP ratio is 180%, so it's pretty high. I think it's higher than US. And we have also booming credit growth and booming house price growth. So these are the kind of things which the crisis has taught us to be worried about. But of course, I mean, the Chinese financial system is unique and it has its own characteristics. So the banking sector seems to be stable, is well regulated with a lot of capital, and certainly has a backstop, has a strong backstop in the government, which actually owns the banks. So the bailout capability is very large, and it would be exercised. What is less clear is the shadow or non-banking sector, and in particular within it, the so-called trust sector. So that is a very obscure sort of angle, or very obscure part of the Chinese financial system, also in terms of its links with the banking sector. So the Chinese authorities are very well aware of that, but they are not, I think they are not decided how to strike a balance between a crackdown, so that the risk of having a crackdown on this sector implying that there could be a credit crunch, or let it go without a crackdown, but then breeding a bubble which could eventually be a threat for financial stability. So I think there is a little bit this element of uncertainty. But in any case, the direct contagion to advanced countries, to Europe, to the US, will be very minimal, because the Chinese financial system, of course, is very close to the rest of the world. So there wouldn't be any direct impact in terms of very unlike the US-based global financial crisis. But of course, I mean, there could be strong second-round effects in terms of confidence, also in terms of if this produces a recession or a growth slowdown in China, of course, this could have implications for other emerging markets, eventually also for Europe and the US. I think I stop here because, but if there are questions, yeah.
Thank you. I have a little question or comment to make, and that is about, when you're studying the communique from the third plenum, which came out in November last year, there are 14 areas the new leadership touches upon, and they have these 14 points. They have 16 sub-points, and when looking a little bit more deeply into it, you can easily find a large number of goal conflicts there, either within the program, or that means that if one objective is met, there will be another obstacle on its way, and And this and I looked at these things and I found at least half of these objectives that are now set up have kind of a conflict of goals, and in one way or another, institutional conflicts, whatever, political, but this also means that the changes the new political membership is aiming at will be extremely difficult to achieve, and there's an objective coming there by 2020. That's another lot of time, for structural changes going on, political changes, social changes, all that. And so when I'm reading these things and trying to reflect a little bit on that, I think my opinion, it will be very hard for China moving forward the way they want to do it. That's my point. What do you think about that, please?
So our China experts always tell us that the sense of timing in China is very different from what we are used to. So they say we shouldn't think in reason in U.S. terms that what is matter is the next quarter. So they have a vision of hundreds of years. So apparently this is how they. So we have to be patient. So reforms are done, but they are done at their pace. So these concerns financial liberalization, the liberalization of the renminbi. It's all done at a very slow and measured pace because they claim they have a long view. So that's a bit of a kind of discussion. So we see them sort of dragging their feet, but they think they are very far-sighted and they look at the long term. So
but they have a time with the 2020.
Yeah. Yeah, no, sure, but I don't know how really relevant that is.
So I think we have one last question.
It's not a question, but an addendum, because this is an emerging markets chapter. I'm Chris Kwasinski. I think a word should be said about the emerging markets of Eastern Europe, which are close to where we are. It should be stressed that EU has now 28 members, with Croatia joining European Union last July. And since the beginning of this year, the Eurozone has also enlarged. Latvia joined the Eurozone, and most likely Lithuania will be joining next year. This is in line with what Paul Horn said about the continuing integration in Eastern Europe. And the final point is, who is still out? As far as the EU membership, probably not for a while. There will not be a new member for quite a while. We can discuss during lunch who the candidates are. As far as the Eurozone is concerned, that's a little bit different question. The big outs are still in Eastern Europe: Poland, Hungary, and the Czech Republic. It's interesting what the governor of the National Bank of Poland recently said in light of the Ukraine crisis. He specifically said that Poland might be better off, Polish financial markets would be better off had it been a member of the Eurozone, because simply of the bad, quote-unquote, neighborhood. Although the ricochet effect on Poland has not been then significant. The currency weakened slightly, nothing comparable to what the ruble did, or not to mention the Ukrainian hryvnia, of course, as you would imagine. And the spreads on the Polish debt have barely moved as well. So there seems to be some resistance. But nonetheless, that is that possibility, but that's still the question for the future. That's all I wanted to say in a way of update. Thank you.
Thank you, Christopher. In fact, I suffer from the North American disease. So we think of emerging markets where they kind of started in Asia, and there's a large block of emerging markets that are here in Europe. So,
including Greece, which has been named an emerging market.
Yes.
Another, as you know, the Baltic Sea is sort of the Mare Nostrum of Northern Europe, just what the Southern Europe refers to as the Mediterranean. The GIP conference took place in Warsaw nearly 2 years ago, and at that time we had a very good representation of all from the Baltic countries, all of them, with the notable exception of Germany. Russia was also represented.
So if we get a thank you for Livio, that'd be great. Thank you. So we're gonna finish up here before lunch is served with Chris Whalen. So Chris has an extensive career. You can scan it in the bios. And we started with banking with Karsten and Paul, and so Chris is going to clean up literally because he's going to talk to us about his views. And Josh said you should not take his silence as agreement with your views, but he wants to get to lunch. Literally, Chris is going to talk to us about banking in China, and kind of all the way around the world. And what I like, although I get depressed, I like listening to Chris because I get a good list of things to watch.
Thank you very much, Steve. Just by way of background, I'm a banker. I'm not an economist. I've been working in the market for distressed mortgages for the past year and a half, one of the largest buyers of non-performing loans. What I want to do today is talk a little bit about my favorite emerging market, which is the United States. The United States is still a very young country, and we behave accordingly. When our earlier speaker was talking about credit creation in banks, I kind of laughed because, really we've only been through two major cycles of leverage in the U.S., the first being after the Civil War when we created our fiat currency, and the second being after World War II when we basically had no private credit creation from the mid-20s on until the 1950s when we amended the Uniform Commercial Code and we started slowly rebuilding non-bank finance. Banks were appendages of the U.S. government through that entire period. And in fact, I've got a new book coming out later this year called Financial Stability, Fraud, Confidence, and the Wealth of Nations that goes into this period because many of you have probably never heard this. Economists don't study the law or banking. But it was Louis Brandeis who really started the Great Depression by shutting down the market for collateralized finance in 1925 with his landmark Supreme Court decision, Benedict v. Ratner. Anyway, let me talk to you a little bit about housing because I think it's of keen interest to everyone. And I want to give you the inside perspective that I've been fortunate to be able to obtain over the last couple of years. We've really had 2 years of improvement in the U.S. market. We were up about 11-12% last year based on the Case-Shiller index. Case-Shiller includes both voluntary sales and distressed sales. This is an important measure, important caveat, because really, if you think of it, why has the market recovered over the past 2 years in the United States? Very simply, the sale of distressed properties by banks, what we call REO, or real estate owned. And the second reason was the Fed. The Fed drove interest rates down so low that they made otherwise rational institutional investors think that buying 1 to 4 family homes and renting them was a good business. In the past year, about 30 to 40% of all home purchases in the United States have been for cash. Again, going back to the earlier comment, how do they fund this? Blackstone, whoever, goes out and gets a big commercial loan, a floating rate loan, by the way, and they go and they buy 1 to 4 family homes. And then they hire a manager and they go out and rent them. What is the gross return on this investment strategy? It's 6-7% gross. They'll be lucky to make money, to be quite honest with you.
That's, by the way, from what we're seeing,
right.
The assumed cap rate, 6 or 7, they're actually getting 3 and 4, 5, depending on the market.
That's right. And, the firm I just left was one of the biggest managers of rental properties in the United States. So what I'm trying to describe to you is an abnormal recovery, because you'll notice I haven't talked about first-time home buyers. I haven't talked about young families going out and getting mortgages, because they can't. We now have a regime in the United States, thanks to Dodd-Frank, thanks to the Basel capital rules, where only the affluent can qualify for mortgages. You now have an income test, 43% debt to income. Most banks will not go anywhere near that. You also have other very strict rules about origination.
In fairness, that debt to income test is above historic averages.
Yes,
so
it is.
I don't view that as a crimp. I would argue that
right.
Wages.
Well, let me get there, Josh. Be quiet. Josh and I were siblings in an earlier life. There's a movie. It's called Start the Revolution Without Me.
I'm going to sit next to Josh.
Right. I'm Donald Sutherland, by the way. Anyway, no, but the point is that what we've seen in the U.S. was very welcome. We're all happy to have a housing recovery. I don't think anybody would say we're not. But what you have to understand is that it's driven by very, very atypical factors. In fact, if you look at the chart and the handout that I put in there, it's basically home price appreciation from my friends at CoreLogic from the 70s on forward to today. And the comment I would make to all of you, especially the economists in the room, is remember that the external factors are more important than the data. The data series has to be very carefully weighed at each point in time that you're observing it for the simple reason that things change so much. One of my dear friends at CoreLogic, Sam Catter, who writes a wonderful blog on their website I would recommend to you, said, well, gee, Chris, I need 10 years of data when I'm doing my analysis. And I said, but Sam, the data is so skewed, it doesn't matter how much time you take. Each one of those periods has enormous changes in the externalities so that you have to be very cognizant of what you're looking at. So today, we still have, as I said before, more than a third of total home buyers who are institutional investors. That's not good or bad. It's just the reality. The other interesting thing is that if you look at why prices have gone up in the U.S. on very, very low volume, less than 10% of the pre-crisis volume in many cases, it's because there's no supply. Anywhere from 20 to 30% of all homes in the U.S. are still underwater. In other words, the owner-tenant debtor cannot sell without writing a check at the closing. Most Americans don't have enough money in the bank to do that. Plus, they need a place to live. If they don't have at least 20% equity in the house, it's very difficult for them to sell. So you have San Francisco, you have a lot of very attractive markets where there's a very severe shortage of housing. You also have another phenomenon I was talking to Josh about last night where the very attractive areas have done well. They've bounced back nicely. But as soon as you get outside the urban centers, you don't see the same degree of rebound in terms of pricing.
Chris, you're making a very specific point here, however. It's not necessarily we do not have the housing stock. It is the repricing that has not occurred that has not allowed the stock to come to the market.
That's right.
At the correct price.
That's right.
And that's a very, very big distinction.
Well, it is, but
New houses built.
But look at the Northeast, the judicial states where it takes 3 years from default to foreclosure. That's by and large what's sitting on the bank balance sheets that hasn't been dealt with yet because it's difficult to deal with.
And that percentage is not, I'm asking truthfully because I don't know, what percentage is that in terms of that has to come off that we need to address?
Well, in dollar terms, it's about $250 billion. There's probably another 150 billion in process on balance sheet that's still marked as performing that hasn't been marked as non-accrual yet.
And so that's what we need to look at when we start
That's right.
to do evaluate these
The-
factors.
A lot of that is ultimately going to be junked in scrappage.
Right.
The
Yeah.
banks have been selling what they have found worth maintaining to investors, but there's a lot of it. You can talk to John. A lot of the REO is going to end up as scrappage. The problem is they're carrying it still at 80 cents on the
Well,
dollar.
they are, and they have to maintain it. You see, when you're a servicer, when the debtor defaults, you have to continue to pay the insurance and the property taxes.
So again, on the investor side of the ledger, these are some of the questions that we look at and we want to know
Right.
these answers because yes, banks may be nice to buy. However, these questions you have to look on a bank by bank.
Well, look, I'll tell you right now. I just sold a bank rating agency last year, and I know the same data set as our colleague very well. Banks are fully valued. Wells Fargo at 1.4 times book, given that they are retreating from what was their primary business, mortgage lending. Where are they going to replace that revenue? All the banks, by the way, are now completely out of wholesale and third-party mortgage, and most of them, you watch the layoffs this year. They're going to have to downsize their business to fit the revenue. The other statistic that's pretty gripping is new loan applications. We're at 1994 levels.
Well, Chris,
And it's simply because, again, most people either don't want a mortgage or they can't qualify.
and that goes to this HPA, this home price appreciation chart. It's worth highlighting the fact that if you were to back out secondary, in other words, vacation homes and investment properties, from this and just look at primary purchase market,
what you would find is that there was only 1% home price appreciation in the primary purchase market in 2012. We don't have the 2013 numbers yet. So when you talk about this being an irregular market, Chris is absolutely right. That's a very, very important statistic.
Well, the other interesting thing that you guys will appreciate as data geeks, loss rates for most big banks, if you go back 20 years, were very low. You could blame that on the boom. You could blame that on excessive availability of finance. But going forward, since finance is much tougher, and since we're probably not going to see nearly as much upside in terms of home prices, you're going to see the actual cost on portfolios of banks, mortgage-backed securities in terms of loss rates. During the boom, big banks like Citigroup, Washington Mutual were actually making money on defaults. When they took possession of a home, let's say somebody died and he stopped paying his mortgage, they would make money selling that house. So they actually had negative default rates for a few quarters. This is what you call a red flag. When you see a bank reporting negative default rates, that tells you, that, again, you have a huge skew in the data series. And that's typical in all of these. I don't think the bank data is particularly stable. I think it's actually very unstable, and it reflects many political, economic, other factors that are affecting their behavior, going back to the earlier discussion. So just my last aside, because I want to let everybody have lunch, I just was very fortunate to become an advisor to a little company called Weiss Research up in Boston. Alan Weiss was one of the founders of Case-Shiller, and he's an extremely smart guy. What did he do? The business was sold 10 years ago. There's been no change in the Case-Shiller model, by the way. And they basically show you home prices at the metropolitan area level or the zip code level. What did Alan do? He built a data series that goes down at a home level. So he can show you individual homes with peers in each locality. When you look at it this way, it's like a herd of animals. Think of it as a very large herd of wildebeest going across the African plains. And what you see today, that data set, is that home price appreciation largely peaked at the end of the second quarter last year. Some of the really hot, attractive markets, or very attractive homes in individual markets, are continuing to go up. But remember, Case-Shiller is an average, and it's a lagged average. In fact, most of the herd has stopped, and the less attractive homes in all of these markets are actually starting to deteriorate again. And it's not because of the economy or anything else. It's just a lack of buyers, frankly. And also, remember, all of those institutional investors who are incentivized by the Fed, they are now looking at the fact that their model is largely going to be dependent simply on rental income and no longer on upside on the home price. And it was really the upside on the home price, I would suggest to you, that drove them into that strategy in the first place. Anyway, thank you very much.
So we have a few minutes before lunch.
Okay.
So, yesterday the question came up about China and Chinese banking. And, the answer was, well, look, they have 3-point-something trillion reserves. Why should we worry about that? But we got a nice model of banking earlier from Karsten. I like that. But I'd be curious what the Chris Whalen model is of Chinese banking.
Well, I'm actually a student of Chinese history. I read Chinese history at Villanova under Cornelius Kiley, who was one of the great Asian experts of his day. There are no banks in China. If you understand it in a Western sense, in China there is no division between church and state. You only have the state. And on every board of every Chinese bank, there is a Communist Party member who sees to the allocation of credit. But you do not pay these loans back. The Chinese have GSEs, which are just as big as ours. And again, these are vehicles for the allocation of credit, but they don't pay it back. The losses are a matter of indifference. So when I see Western economists fixate on Chinese economic data or financial data like it's at all valid, you have to just wonder, what are we smoking? Everything in China is about stability. If you understand the Confucian roots of the Chinese Communist Party, you remember the old saying, political power comes from the barrel of a gun. But we always forget the last part of that quote, which says that the party shall never be subject to the gun. And this comes from the ancient Confucian worry about instability coming from the periphery and going to the center, which is how it has happened many times there. You know, China's an allocation model. They want to avoid stress. They will allocate money or not. If they see home prices or real estate prices getting overheated, they will turn down the spigot in terms of flows. But to assess it the way we look at a European bank or an American bank, I think is kind of silly. I can't remember who it was. There was a wonderful economist years ago who gave a speech in Hong Kong and basically looked at the audience and said, do you really believe these statistics? They are too good to be true. And so when people say, well, China's growing at 7% a year, yeah, the statistics are growing at 7% a year. But is the economy really growing? No, because again, as was pointed out, they invest heavily. My dear friend Jim Rickards constantly tours China, and they show him these brand new cities with no people. And more importantly, there's no economy underneath those cities. They're simply built with allocation of currency, which they earn from us. But now that they don't have us creating lots of debt and buying their products, as our colleague was saying before, they have to change. Are they going to raise their income levels to Western levels? Probably not. You know, Josh and I were talking about that before. So I think, you know, China to me is the great worry, because when everyone wakes up and realizes that the emperor has no clothes, or no schmuck, or whatever we call it, right? That I think is going to be a shock to the West. The West wants to believe that they're like us, and they're not.
So I'll finish with a story that you reminded me of. So in I think 2004, but it could have been 5, they IPO'd the Chinese banks, the big four. So this is People's Bank of China, Industrial Bank of Commerce. And I was there with a group of investors for a week, and we saw all the big banks. We saw their managements. We were at the law firms. And it's the end of the week. And, you know, it's been a long week, and it was like 3 or 4 long-only people like me and 3 or 4 hedge fund types. And one of them had your personality from Brooklyn. And the reason I want to set that up is we sat through this just very long meeting with the chairman of the People's Bank of China. And they were going through the numbers, which were unbelievable. Non-performing loans from 15 to 4. It was like you looked at these numbers and said, this can't be true. And it was, you're going through a translator. So I go, so could you help it? This all happened in 2 years. Could you walk us through some examples? And they said, well, you know, there's this town that had a steel mill and it was non-performing and we wrote it off. We just cleaned it up. And I'm thinking about what Chris said. No, it's a town. The steel mill employs people. That means not only is it the head of the bank, there's the mayor, and there's the local Communist Party official, and those 3 run the town, right? So I asked the question. I go, okay, so the steel mill, did you shut it down? And they go, oh, no. I go, oh, so all the people that worked in the steel mill, what are they doing? Well, they're still working there. I go, oh, okay, who bought the steel mill? He says, oh, the town bought the steel mill. Well, you know where this is going? I go, who lent the money to the town to buy the steel mill? They didn't blink an eye. They said, we did. So with that, bon appetit.